Hi everyone, it's Tom Buck from the Calder Group here again. We're now in lockdown, we're working from home as you can see. I've got Alex from Blackfinch Wealth with me this afternoon, following on from the videos that we did last week. Hopefully you've seen them, if not we'll put the links. But obviously things are moving forward, so we wanted to have another chat. So, hi Alex.
Hi Tom, how you doing?
I'm not too bad, thank you. How are you coping?
Yeah, not too bad. Yeah, all set up in the kitchen now, so and things are running okay from working from home, so not too
No,
bad.
that's fine. Well, our internet is a little bit hit and miss, so we'll see how we go on getting this out. I'm just going to go straight into it then, because obviously we want to get information, and this is really cutting through the noise of the media and making sure people are aware of the reality of what's going on. I suppose to start is, as we're now in lockdown as a nation, um, is it possible to foresee the impact this is going to have on the long-term investments that clients hold?
Yeah, I mean, to start with, the initial market reaction to the lockdown wasn't actually as negative as many perceived. So markets have actually taken that initial lockdown period more as a positive than a negative, and certainly following suit from other countries that have done the same. So I think of greater importance right now is those infection rates and death rates in countries across Europe, particularly Italy. So I think we're now in the fourth day of seeing the rate of confirmed cases slowing in Italy. So these figures are absolutely crucial, and to try and establish a trend of what's going on. So we're seeing also Wuhan having their restrictions lifted on possibly the 8th of April. That therefore does create a potential risk of reinfection again. So the markets are a bit apprehensive about that. But right now the lockdown is priced in well, and absolutely it's those infection rates which we're paying very close attention to drive returns from here.
And as you say, yeah, we're starting to see across Europe, certainly those come down. We're seeing it going up in America. And obviously there are questions about what's actually happened there. Now, we are getting clients where they've got cash are starting to say, is now a good time to invest? So it's a case of what should they understand and what potential risks above the normal investment risk are we factoring into new investments at the moment?
Yeah, of course. I mean, I think from our point of view, there is slightly more risk to the downside than the upside in the immediate term. But to be honest with you, if you're investing with a 5-year plus view, there are a lot of areas in the markets which are extremely attractively valued. They haven't been at these sort of levels for a long time. So as I say, if you're looking on a longer term basis, then the sort of valuation standpoint is quite attractive. We're hearing a number of our underlying fund managers saying the same. So they're starting to move their active funds into buying up particular companies in certain sectors. So my message really, I suppose, to clients is, so long as they're quite comfortable knowing that the volatility will absolutely be there in the short term, that's a volatility up and down. I mean, we've seen that this week with UK markets posting a near 10% gain. I mean, that's kind of almost unprecedented. It's happened very few times historically ever. So I think clients, if they're comfortable with that, they're comfortable knowing that short term you will see some wild swings in that money, then that's kind of what the client needs to consider if they're wanting to deploy capital right now. I think the most important point to note, though, is when we do see sentiment change in the market will react faster than any investor or client certainly can. So I think it's a case of whether the client actually wants to be in there and capture all of that upside, or miss a little bit of that upside and wait for things to calm down a bit before investing. So two options, obviously, with two different outcomes there.
Okay, so yeah, and like you say, if we go back to the basic principles that everyone should be looking at, which is you invest in the markets for a long period, you're not in there for a quick win, then just accept that volatility, sit tight, turn off the news, and don't hear anything, and don't look at anything for as long as possible, and make sure it's money you can afford to lose effectively.
Well, yeah, absolutely. And also don't forget the point we covered in our last video as well. The whole multi-asset and globally diversified approach as well will benefit there. So whilst media and the news will really only report on what's happened in global stock markets, the actual underlying construction of our portfolios that we manage looks at other assets that are not just stocks and shares. So that multi-asset approach will help to cushion that volatility in the meantime as well.
Yeah, absolutely. Fully agree with that completely. Okay, we've seen a number of property funds close, and obviously some clients are going to panic about that. Are we likely to see any other issues with funds? I'm assuming you're talking or managing to talk to fund managers where you can. But I suppose for some clients, the question is, are we going to see more fund closures, particularly when we've had the, shall we say, well publicised issues of a certain fund manager just before this started to happen?
Yeah, I mean, I think the thing with the property fund closures, firstly, Blackfinch don't have any exposure to any of the property funds that have gated. So first and foremost, clients aren't exposed to that at all. The reasons those funds are gating in the industry is purely because the assets themselves, so physical property, is so illiquid. And when we've got so much uncertainty going on in the world at the moment, these property funds cannot sell the properties to meet investor redemption demand. So the assets are simply too illiquid to sell. So the fund has no choice really, apart from to gate, to give the fund manager time to sell those properties, to realise the assets and meet the investor redemptions. We've seen this happen before, and I think we'll start to see a big change in that part of the industry there. But as I stress, the Blackfinch portfolios are not exposed to those funds whatsoever, purely because of those liquidity concerns. Other funds which could struggle as well are those very small small cap focused funds. So funds that focus on small businesses globally that don't have the liquidity that the larger companies do. We could see some funds struggle there. Again, though, there's been no exposure in the Blackfinch portfolios to those, and we haven't had any liquidity troubles to date. So we're obviously pleased from that point. But yeah, it's something that we're keeping an eye on, and we could well see in other areas of the market. Yes.
Yeah, and again, that comes back down to having that good spread of assets, good spread of funds, not consolidating or concentrating too much in one place. So it's back down to basic investment planning that obviously we talk to clients about. We utilize your funds for the right clients, or your portfolios for the right clients. Again, yeah, it's come back to basics, and as long as the basics are right, you should be riding this out and managing. So even if a fund does close, if it's only 5% of your portfolio, shouldn't be a major issue in the short term.
Yeah, that's absolutely right, and it's absolutely our job to make sure that our portfolios, and therefore your clients, aren't exposed to funds that have too high a risk of being gated and liquidity. So again, that's where active management is sort of coming into its own now, because if we did see a risk in the liquidity areas of the portfolio, we can move assets out of there. But as things stand today, we've done our liquidity checks and we're quite comfortable with everything that's in there. And to date, nothing's suspended or closed, so everything's trading daily as it should.
Excellent. And really, just two last things leading on from that. What are investment managers now looking at? Because we're starting to see a pattern. We've seen in pretty much the globe, almost sector by sector and geography by geography, close down, go into lockdown. We're seeing the impact. We must be getting information now on what kind of industries and what kind of companies are going to come out of this in the long term, stronger, better, leaner. What kind of areas are people continuing to look at, and our investment managers now going, we can see bargains and we can see real long-term opportunity?
Yeah, absolutely. So our underlying fund managers, and is a core belief of ours as well, is focusing on companies with really strong balance sheets with positive free cash flow. So those businesses can actually weather these particularly uncomfortable storms, and are more likely to emerge the other side of this in a stronger position, and also taking market share off some of their competitors who have not been able to weather this particular storm. In terms of sectors, I think technology is probably the obvious one here. I was talking to an emerging markets fund manager the other day who was talking about the automation in factories and production lines. This virus is likely to spur on businesses to really drive that automated production line, because of course, whilst machines can get viruses of certain kinds, they can't catch this particular one. And I think this has just emphasized the importance of having, for those sort of businesses, that sort of technology in place in the company. So that's a sector we see benefiting quite strongly. And again, Asia, emerging markets, and in China, we're still expecting positive growth out of China and India. I mean, albeit a lot less than we were expecting initially, but that should still be positive. And the middle class, the emerging middle class, there is a huge growth area for the whole globe. So again, we do expect that to drive global growth going forward. So some very interesting areas. But yeah, it will be a different world we go back to than the one we left once this virus has subsided. I think that's for sure.
Yeah, it'll be interesting to see where the medical industry goes, because obviously they've suddenly found that they can speed up. Well, I think we had news today that Dyson have, in a matter of days, developed, created, and are now building, and have taken the order, I think, for 10,000 units from the government in terms of incubators or equipment to help deal with this. So it shows that actually the human race is still very, very adaptive, very, very quick, very ingenious, and there is always going to be a positive that comes out of every negative in some form.
Yeah, hugely. Yeah, I absolutely agree with that. Yeah.
Okay. Alex, aware you've got an awful lot going on and things are changing on a regular basis, but we're going to try and do this every week now until things subside and become a little calmer. So again, have a great day. Look after yourself, keep safe, and thank you very much for your time.
Okay, thanks, Tom. Speak to you soon.
Take care.
Cheers.